space that we invest in is the US oil and gas market, particularly mostly developmental oil wells, working interest investments. So normally, when you look at a standard private equity play, you buy at £1 and you hope to sell at 10. Either by way of a trade sale or a listing or something like that. But our structure is different. We take direct interest in an oil well, and we essentially then start to draw profits from that for as long as the well produces. Which in many cases can be as long as 20, 30 years. So that creates a very nice residual income for a well-structured, diversified portfolio. It's a very supported investment instrument. It's quite well known in the States, especially in places like Texas, where obviously the reserves exist. And Robert Kiyosaki, who many of you may know as the author of Rich Dad, Poor Dad, is also a prolific investor in this because of that residual passive income that it creates once you start investing into these successful structures. So without any further ado, let's get started. And just providing a bit of background as to why we're very confident about the future growth prospects of the oil market. Some facts and figures here. The world uses at present about 36 billion barrels of oil per year. So that's a tremendous amount of usage. Now, this number has been rising in terms of demand rather than falling, even though we're obviously hearing a lot about the green revolution, renewable energy and so forth. Here's the facts. 70% of crude oil is used to ultimately manufacture and refine it and turn it into diesel, petrol, jet fuel. But 30% is also used for petrochemical purposes. So the pens on your desks and various different items contains crude oil as a raw material. And it really affects every bit of our lives, daily lives. The toothpaste that you're using, the lipstick that you're using, the football that you're kicking around, it all contains crude oil. So the market is flooded with it, and demand is expected to grow. Now, the United States is the top oil producer in the world, manufacturing about 12 million barrels per day, or extracting rather 12 million barrels of oil per day. That's expected to increase to about 14 million over the next 5 years. And American oil production actually makes up 1/7 of global oil output. So we like the States. It's obviously got rule of law, great infrastructure, good access to labor, a good market there. And that's why we're investing in that among many different reasons. So let's look at, the general ways that you can invest in oil and gas. You're a standard investor, you like the sound of the market. Where can you go to get exposure to the asset? First of all, you can obviously go and buy some shares in BP or Shell. Or, if you prefer to take a walk on the wilder side of life, you can maybe start buying some small cap companies, explorers, and they possibly can do extremely well for you. You can also trade the commodity through CFDs. If you have a lot of cash, you can actually lift physical crude and trade the actual stock. Then there's the way that we look at investing, which is essentially the private participation in oil wells. So owning essentially a piece of an oil well. That's what we're really after. Because often, stock market is influenced by a variety of different factors. Asset pricing can be affected because of negative macroeconomic news, geopolitical issues. Investing in an underlying asset like an oil well is not so much directly affected in terms of its volatility, because really what you're getting out of it is your income. So just to explain a bit on the backdrop here, there is a very high barrier of entry normally investing into an oil well. What you'll have to find is deal flow to begin with, and although there are several deals promoted in states like Louisiana, Texas, or Illinois, it's difficult to find the good ones. And that's really what we're about, is trying to work with our partners to identify what holds good value. Does the operator have the sort of experience and that sort of thing? And even if you do find a deal, and you're able to go through all of that, you probably need at least $500,000 to be able to participate, depending, of course, on the drilling program being proposed. And it's generally quite contained. Investment clubs, high net worth individuals, you need to be able to break into that space, and that's really the platform that Saxon offers, is access to that deal flow. often we do get asked the question, of course, you know, because what tends to happen is operators create what they call a prospect. And, you know, they'll say, well, listen, here's a great deal that we're looking to do. Here's what we forecast we'll get. This is the geology. This is what the asset is that we're going after. You know, and I'm inviting investment in. So the question we often get asked is, well, if these deals are so great, why do the operators syndicate? Why do they get investment funds in? Well, the fundamental fact is most operators operate like any other normal business. They like to diversify, they like to spread their risk as well, and they are more than happy to normally invite investment partners in and obviously give away equity in doing so, but at the same token, they're able to develop a number of prospects across numerous different lease areas, and in doing so, you know, diversifying their business model. It's just the way it works over there. So, looking a little bit more at the type of assets that we produce, because we tend to think in oil, and you know, you think obviously it is risky, and don't get me wrong, there are numerous risks involved investing into this particular space. But our focus is on developmental wells. You know, just to compare and contrast there for a second, exploration wells are used to search for oil in uncharted regions. So these wells, they generally carry higher risks, and it's also known as wildcatting. And if you don't hit it right, it's also known as a dry well, which basically means a complete capital loss. Our focus is more on developmental assets. So this is where you sink wells into areas of known reserves. And obviously the strategy itself has a lower risk profile because you're not going into some new frontier asset that you're looking to produce. There are two main types of prospects that we pursue. One is rework projects, where we go perhaps into fixing existing well bores. Or infill drilling, where we basically create more wells into a lease area and essentially go into areas and formations that we know where the oil is. And these wells, although not risk-free, in comparison to exploration assets, of course, carry a lower risk profile. Let's just delve into a deal well, we've recently funded, and you know, we've got a series of leases available that we're going to be going after, and we really like this particular asset. And it's called Illinois Waterfloods. So as the name would suggest, it's actually in the state of Illinois, in Crawford County, which is about a 3-hour drive south from Chicago, so if you want to place that on the map. Now, it's a 6-well package in Crawford County. Now, that is actually a very, very important bullet point, because everything, when you look at participating in a well, is about the well. Because if you sink it down and you hit the pay zone, you're making profit. You know, you're extracting dollars. That's really what's happening. So the more wells you have, the lesser your risk ultimately, because you're producing from a number of different places. And this is what we call a 6-well package. It's based in the main consolidated field of the Illinois Basin. They're using advanced technology, basically very simple. Just to give you some brief background, this area was a prolific production area back during the Second World War. You know, America was oil hungry. There was this military-industrial complex that needed energy. Crude oil was that energy. But what did happen, there was not very sophisticated drilling, you know, or operating. So the gas was flared pretty aggressively, which essentially reduced the pressure in the reservoir, and that ultimately, the moment you take the pressure out, well, then you can't extract the oil any longer. But there was so much of this, they would produce from these, you know, formations for 2-3 years, and then they'll just move on to the next lease. So what we're doing is we're water flooding it. It's not fracking. It's just simply plain water that we're injecting into known reservoirs, which displaces the oil out of the pockets, and we then extract it from 4 different production wells. And that's how it basically works. We've got an experienced and successful operator. That's really, really crucial. We need to understand that the operator, in other words, the individual that's in charge of day-to-day running of this asset, has the relevant experience to be able to execute the well program. And it's a turnkey drilling solution that we have, and what we're targeting is essentially quarterly distribution of net revenue. So again, money goes into the ground, we start production, we start earning revenue, quarterly payments forecasted, and the life of well is forecasted to be around 20 years. So 20 years worth of cash flow, worth of return coming out of the ground for you. Just about the operator, this is really, really important. I've mentioned it before. Any due diligence when it comes to assessing a deal is not just about the geology and the engineering or the finances. It's also about the operator. If we were proposing a horizontal drilling program in the Permian Basin, Maverick Energy would not be the guys to go to. Operators tend to have a speciality in their types of field, and they know the geology in the area. Now, Maverick Energy, based in Robinson, which is the town out there in Crawford County, it's a family business that's been around for 125 years. So Larry Neely, who's the president, is fifth generation oil and gas. They operate about 300 oil and gas wells, of which 90% comes from waterflood deals. So they know their way around doing that. So they've obviously got experience in the field, and they're perfect for the sort of well program that's being proposed. Important to also recognize is often operators would promote deals, but they won't put their own money in. You've always got to question that. With what we're doing with Maverick, they cover the cost 50%. So they've got skin in the game. If it doesn't work out, it doesn't work out for them either. So that's always a very, very important vote of confidence to be looking for. The obvious disclaimer I need to say that past performance, of course, is no indication of future performance, but this does give us some sort of guidance on what is truly, can be expected. These are deals that our partners have done. All waterflood deals, all Crawford County, as you can see there. If you see that rectangular blue box, the Wiseman-Haskins prospect, that's where our leases are based. And if you can also note, we're on a very nice trend line there, also sort of moving southeast. So let's just look at these yellow boxes really, really quickly. On the top is the lease name. Below that, AA is average annual return. ROR is rate of return. And below that is the cumulative barrels of oil that's been extracted from that lease. So let's look at it. I mean, obviously a standout one is there at the top. I don't know if you can see that far, but it's the Esso Allen lease. That has returned its investors 14 times their money back, with an average return of 68% per annum. So that's roughly the sort of cash flow that they've received back on an annual basis. We move down the trend line. We look at Allen Ames. That's sort of 10.58. We've got AP Woodworth there at 7.5 times cash back. JW Dennis, 5 times cash back. So generally the structure of this is you're investing in it, and you're then anticipating future cash flow. And that continues for a long period of time now. Of course, once these wells have a good production profile, we can look to sell our interest. So that could create somewhat of a liquidity event. But really what we're after here is what they call mailbox money, that residual passive income. And obviously, as can be shown there, that's what has been achieved on these type of deals. And again, just looking specifically at what we're currently proposing. Now, there are a number of disclaimers because of time constraints. I'm not going to go through it, but the point is basically this. This information is for illustration purposes, but it has been actually verified by Maverick. So, they've checked it out as well. And we've also looked at other production plays in the area and what's being achieved. So let's just very quickly look here. There is a table there, and we are assuming different levels of oil pricing. $80, $70, $60. We probably should have another one for $50. And this references WTI, it's not Brent. So on the left, you see average barrels of oil produced per day. So let's look at the very last line there, where we're anticipating production from our 5 wells, 5 plus 1, so 6, of 70 barrels of oil per day. Let's assume we're selling our goods at $60 a barrel of crude. That should ultimately translate for us, and this is based on a $70,000 investment, that should translate annually roughly about $42,000 back to you once production starts. So it normally takes about 6 months or so to get ready. And On the very last column, it gives an indication that it should take you, roughly speaking, about 20 months, therefore, to achieve what is known as payout, which is the point where you get your original capital back. Thereafter, you're in it for free. We've just recently done a funding of this on Angel EQT, where we were quite, nice to lower our average investment. Generally, we want to go for $5,000 US. It's priced in dollars. That's where our assets are. But we did do it for the platform for a very, very low buy-in of 1,000. So we may decide to do the same. The only problem is, frankly speaking, is the administration that goes with that for a large number of smaller ones is intense. So, but yeah, 5,000 is normal company minimum, subject and obviously at management's discretion.